A quiet supply risk is emerging in the world's largest silver-producing nation. At the same time, gold markets are sending a subtle weekend signal that many traders won't notice until prices have already moved. What's unfolding right now could influence how both metals are priced in the coming days. Before we examine the data and its market implications, make sure to subscribe and hit the like button so you stay informed about major financial developments and don't miss the signals professional investors are already watching. Mexico remains the world's leading source of silver production. Roughly 1/4 of all silver mined globally originates from Mexican operations. This is more than a simple statistic. It represents a core pillar of global supply. Any meaningful disruption within the country immediately affects worldwide silver availability. Road blockades, transportation delays, and airspace restrictions do not instantly halt mining operations. Mining systems do not shut down overnight. The concern is not an immediate production collapse, but added strain on a system that is already operating under tight supply conditions. In our previous discussion, we noted that speculative long positioning in silver had fallen near 20-year lows, even as prices pushed sharply higher. We also highlighted how the Shanghai premium was already indicating physical demand, outpacing paper market pricing. When physical supply is tight, markets do not need a complete supply failure to adjust prices. Uncertainty alone can trigger adjustment, and uncertainty is exactly what Mexico is introducing into the market right now. Silver prices currently do not reflect a supply disruption scenario. The paper price, around $84, assumes normal output and uninterrupted exports from the world's largest producer. In commodity markets, physical realities tend to move first, while paper markets respond later. That order matters. Traders familiar with supply shock dynamics understand why this development deserves far more attention than it is receiving. Now let's connect this with another signal that addresses a question many traders woke up asking today. PAXG, the gold-backed cryptocurrency token that trades 1-to-1 with physical gold, is currently showing approximately a $50 premium compared with Friday's Western market close, US and European markets. Spot gold ended the week near 598, yet the token is trading higher on Sunday while traditional markets remain closed. What does this suggest? Crypto markets operate around the clock. Gold-backed tokens effectively function as real-time sentiment indicators when futures and spot markets are offline. When a $50 premium appears ahead of Monday's open, it reflects traders actively bidding for gold. Exposure during hours when conventional markets are unavailable. This is a forward-looking signal, not a guarantee. Markets can gap higher and then retrace. Liquidity conditions can distort pricing. Weekend activity in a single instrument does not determine how institutional markets will open on Monday. Still, it offers directional insight that experienced participants monitor while others wait for mainstream coverage after the move has already occurred. If gold follows this signal, the immediate level to watch is last week's high, specifically the peak formed on Wednesday, February 11th. A break above that level would confirm continuation of upward momentum. To be clear, this is educational price action analysis intended for short-term traders. I'm not predicting price direction or issuing trading signals. The purpose is to explain how professionals interpret market structure and price behavior, a core part of the financial education this channel aims to provide. There's also an important contextual factor for Monday's session. Shanghai markets remain closed and will reopen Tuesday. As a result, liquidity will likely be thinner than normal. Low liquidity tends to amplify price moves in both directions. A sharp upward gap may appear stronger than underlying demand justifies, while reversals in such environments can be equally aggressive. For short-term traders, low liquidity does not confirm a trend. It is a condition requiring additional caution. Looking specifically at silver's structure, the lower timeframe trend remains intact at the time of recording. The next technical objective sits near 86.3, which also corresponds with a previous weekly high. This overlap between technical resistance and historical price memory creates technical confluence, meaning multiple signals align, a level carrying greater significance than either factor alone. Beyond that lies a resistance zone between 87.2 and 89. This range is critical. It is not an area suited for slow consolidation. If price stalls there, momentum weakens. What the market would need instead is decisive movement, strong volume and conviction pushing price through the zone rather than lingering inside it. Again, this is structural analysis, not advice. Now we move to a deeper layer connecting these developments to a much broader picture than a weakened premium or temporary disruption in Mexico. Previously, we discussed the US dollar's share of global reserves falling to a 32-year low, central bank gold holdings surpassing treasury holdings for the first time since the mid-1990s, and growing stress quietly emerging within COMEX delivery mechanics. Here is another important data point. With 4 days remaining before last notice day, the deadline for delivery notices, on the February gold contract, open interest still equals more than 436,000 ounces, roughly 13.5 tons of gold. That figure stands 24 times higher than the average open interest normally seen at this stage of a delivery cycle and more than double the previous record for a comparable period. Even more unusual, February open interest exceeds that of the upcoming March contract, something that may be unprecedented in recorded market history. For traders familiar with COMEX delivery cycles, this pattern often signals a short position that remained open after first notice day, likely expecting to exit later but now facing reduced liquidity and limited exit opportunities. Friday's trading volume totaled only 134 contracts, not a liquid environment for unwinding a position of this magnitude. This raises a straightforward question. Does the short holder possess the physical metal required for delivery? If not, historical precedent suggests a major bullion bank may step in during the final days to issue delivery notices, potentially creating additional market disruption. Approaching a Monday open where gold-backed crypto is already pricing higher before Western institutions have even logged in. Historical research has documented how concentrated short positions in paper gold markets $920 million precious metal settlement involving JP Morgan in September 2020, along with regulatory enforcement actions, demonstrated that manipulation cases were not theoretical. They resulted in documented penalties and admissions. Geopolitics adds another layer, largely disconnected from metals coverage in financial media. The United States has signaled acceptance of Iran maintaining uranium enrichment, which may appear to reduce escalation but does not necessarily remove risk. Significant military assets have moved toward the Middle East in numbers not seen since 2003. Deployments of that scale suggest negotiations do not automatically eliminate strike risk. The threat may be paused rather than resolved. Markets pricing metals at current levels are partially reflecting geopolitical tail risks that have. Meanwhile, a broader monetary transition continues quietly. Treasuries, allowing persistent U.S. deficits to be financed externally as foreign buyers absorbed debt issuance. The seizure of Russian reserves fundamentally changed how many geopolitical risk. Central bank gold accumulation surpassing Treasury holdings for the first time since the. As central banks shift toward gold, fewer inflationary pressures generated by U.S. deficits are exported abroad. More remain within the domestic economy. That outcome is arithmetic. Economic analysis has long described how reserve currency status allowed inflation to be. Back home, current data suggests that mechanism is beginning to activate. Low liquidity during Shanghai's closure works in both directions. A gap higher on Monday, while structurally important, has not yet produced verified reductions in mine output or shipment data. The risk exists, but it remains a potential supply shock rather than a confirmed one. Similarly, previous COMEX anomalies have sometimes been resolved through institutional intervention without triggering full market dislocation. Bullion banks have managed comparable situations before, assuming failure would be as misleading as assuming stability. And while many analysts project extremely high future prices for gold and silver, those forecasts often rely on long-term monetary resets and historical comparisons, operating on timelines far longer than most investors expect. Being correct about direction and being correct about timing are entirely different skills, and confusing the two is how accurate ideas still lead to losses. So what does all of this mean collectively? Mexico has introduced genuine uncertainty into the world's largest silver supply source, at a moment when the physical market is already tight and delivery demand exceeds available registered inventory. The gold-backed crypto premium provides directional information ahead of Monday's open, not certainty. Gold's structure points toward last week's high as the first momentum test. Silver's trend remains intact with 86.3 as the next key price target, followed by a resistance zone that must be broken decisively rather than slowly worked through. Shanghai's reopening on Tuesday will be critical, representing fresh price discovery from the world's largest physical silver market, returning after a week offline into an environment shaped by supply uncertainty, unresolved geopolitical risk, and historically unusual COMEX positioning. The monetary regime shift, often described as a future event, is becoming increasingly visible in present-day data. Rising central bank gold purchases, declining dollar reserve share, delivery stress, and persistent physical premiums. This is not speculation. It is an observable pattern built from publicly available information. This channel provides financial education, not investment advice. Verify every data point independently. COMEX delivery figures are public. Commitment of traders' reports are public. Shanghai premiums are public. Those who examine primary sources will understand why current developments may represent more than ordinary market noise. Invest with logic, not hype. If you found this breakdown valuable, make sure to subscribe and like the video so you don't miss the next major market update. And I'd like to hear your perspective. Do you think gold and silver are already pricing in a larger shift, or is the real move still ahead? Share your thoughts in the comments below.